RBA update, where Evan and I get to look at all of the latest economic data and try and make sense of the world and try and make sense of the numbers. Now, the big themes of this update include mixed data coming out of the US, but the Fed Reserve leaves the door open for a potential rate cut. Then also, Evan's going to talk a little bit about the observations he's seeing in the EU and also the UK economy. And then back home, it is all about the RBA's decision and their big rate call. So welcome to the show, Evan.
Hello, Ben. You're right. It's a massive August. I mean, what a way to start the second half of the year. Because don't forget, not just are we talking about what we've just outlined, we've still got three, major RBA meetings to go, including the one we've just had. You've got the Fed doing the same thing, the ECB, the European Union, as you said, is going to be fascinating going home because it's a lead indicator for us because they are actually doing what we expect to happen at the end of this year, start of next year. So such a big show, and why August may actually be quite a month that goes down as the change that's going on in the global economy and where we sit in that as well.
Yeah, loving it. I'm looking forward to it. So let's get straight in. We'll start obviously in the US where we normally start. So we saw in terms of, we got the GDP data for the second quarter, and we saw that the US economy expanded at an annualized 2.8% in Q2, which was up from 1.4% in Q1, and it was above forecast of 2%. And that really is quite an interesting result. We'll get to that in a minute.
Mm-hmm.
In terms of, it was stronger than expected, led by consumer spending, private inventories, non-residential investment, and government spending led by increases expenditure in defence. On the other hand, residential investment contracted for the first time in a year, so that was down, and the net trade dragged down also growth in the second consecutive quarter as imports rose faster than exports. What did you see in the GDP numbers that caught your eye, Evan?
Yeah, I think first and foremost, the housing numbers you can't go past because they fall straight into the Fed's remit with regards to how do you slow down an economy? Obviously, you take money out of it, you increase rates, their ability to therefore do big ticket items is there. Housing slowing is a massive headache for the US in terms of what it is. So that was the other one. Net exports are also what catch my attention because particularly over the last 3 to 4 months, the US dollar has been really, really strong. And you compare it against something like the Japanese yen, for example, or the euro, where the yen's just been so incredibly cheap. It's hurting the Japanese economy domestically, but internationally it's been fantastic for them in terms of, being a big exporter, particularly of high-end products. So they were the two that caught my attention. Politically, it also falls into it. And I know I'm getting a little bit off track here, Ben, but I want to say it. We are going into the November election. This is part of what Trump is trying to really push, is that US manufacturing is under pressure by the US dollar, and that have a look at net exports. They're going the wrong direction. Your house is under pressure because interest rates are too high. So they were the two things that politically we've been hearing about. Now we've got actual data that backs that call. That's a bit scary in some people's eyes, and why the Fed has certainly sat up and said a lot of things we were expecting, which is that we'll come to this in a minute as well. September's live, and their July meeting was basically just preamble for what's going to happen in September.
Okay, so let's jump into the inflation story first then, because, a real surprise on the upside in terms of the actual print of how strong the economy was. But when we start to unpack this data, it doesn't look as strong in the forwards as what it was in terms of Q2. So inflation, we saw the annual inflation rate in the US fell for a third straight month to a reading of 3% in June. And this is the lowest since June of 2023, so 12 months ago, and compared to a 3.3% print in May and below the forecast of 3.1. So the inflation story is quite good. Annual core inflation also slowed to 3.3%, which is a fresh low since April of 2021. And that's from a 3.4% reading in May. And the forecast says that will remain steady going forward. So what did that mean in terms of the Fed's decision on interest rates? So we'll jump into that before we unpack that. So we saw that the Fed Reserves maintained the Fed funds rate for a 23-year high at 5.25 to 5.5% for the 8th consecutive meeting in its July meeting, and that was in line with expectation. Policymakers noted that there has been some further progress towards their 2% inflation goal, although it remains somewhat elevated. The central bank judged that the risk to achieving its employment and inflation goals continue to move in better balance. So it looks like they're threading the needle here. In terms of what that looks like. Still, the Fed does not expect that it will be appropriate to reduce rates until it has gained greater confidence that inflation is moving sustainably towards their 2% target. Now, during the regular press conference, the Fed Reserve Jerome Powell said a September cut could be on the table if inflation moves down in line with expectations, and that could, but he could also imagine scenarios in which the Fed could cut rates several times this year or not at all. And so a bit of a mixed message there from the Jerome Powell in that comment, Evan.
Yeah, and I found it fascinating that was, it's not like him to sort of mix his words like that. It was a real through to the keeper moment, right? It could do this or it could do that. We just don't know. And that for him normally is not something that he does. But, and you've highlighted here, this, and the chart that you can see at the moment is fascinating because we've now just ticked over 12 months since the last time the Fed actually moved on interest rates, whether up or down.
Yep.
Historically, that's long, right? Historically, the Fed normally takes between 4 and 6 months to move rates in either direction, whether it's 1 or 2 or whatever else. So we're going through a very long sustained period of not actually seeing any activity. So it builds up. History tells you September's looking pretty reasonable for a chance. You then also go back to that GDP. You go back to that inflation figure. There is an argument that they could actually hit the hard landing because defense spending is something that will probably actually start to moderate. So that comes out of that GDP figure. Consumption is under pressure, although it expanded. We know that this seasonally is the upside. This is their summer season. They do spend seasonally quite strongly during the second quarter. So those two things should moderate. So very quickly, if you don't unwind the handbrake, which is currently on there, you could see quite a, not just the narrow path and threading the needle, using your term, Ben, but you could actually hit the ground a little bit hard. And so if you look at, Goldman Sachs, Morgan Stanley, and Citibank, the three of them are now actually saying that the 3 remaining meetings in 2024 are all live, not just September, all of them could actually see 3 rate cuts from basically starting in September, because we know the Fed has said, and nothing's changed about this, that once they start, it'll be a pretty orderly decline back to what they refer to as the neutral rate, which in most people's eyes is about 2.5%, 3%. So that would mean 75 basis points, so 0.75 of 1% by Christmas, with another 2 to 3 rate cuts by this time next year. So that would be a massive input to the US economy and a massive input to the global economy because, again, the US is still a banker to the rest of the world. We will benefit from this.
So let's have a look at what data is supporting the sort of deteriorating look of the US economy. And to Evan's point around, that landing could be a little bit harder than expected. The unemployment rate in the US rose to a reading of 4.1% in June. That's the highest since November of 2021, and it's up from 4% in the previous month and surprised market expectations, which had the forecast remaining flat. Now, the number of unemployed individuals increased by 162,000 to 6.811 million, while employment levels increased by 116,000 to 161.199 million. So, and that's, those numbers are starting to itch up in terms of the unemployment rate. You can see on the chart there. Meanwhile, the labour force participation rate also went up to 62.6% from 62.5. So there's more people looking for work. That's also adding to where that number lived. Let's also then go into the next slide. We saw the consumer confidence story. So the University of Michigan's consumer sentiment in the US was revised higher to a reading of 66.4 in July from a preliminary reading of 66, and that's remaining at the lowest in 8 months. And you can see from the chart, the trend is clear in that sort of that US consumer is becoming more and more wary as the year rolls on. And, in terms of when you also then look at the retail sales results, that also supports that particular story. So here are those retail sales results. We see retail sales in the US stalled in June from May following an upwardly revised 0.3% increase in the previous period. And that was obviously that flat recording that we see now in the charts right in front of us. So lower employment. Confidence is down. Retail sales is flat. So this is that sort of, that hard landing that Evan is probably saying that there might be a risk of if the Fed doesn't move on their rate situation. Now, finally, let's wrap that up before we get, the sort of key takeaways from Evan. We saw business confidence. So the ISM manufacturing PMI unexpectedly declined to a reading of 48.5 in June from 48.7 in May, and that was below a forecast of growth in that area at 49.1. Now, the reading pointed to the third straight month of falling manufacturing activity and the lowest since February, as demand was again weak, output declined, and inputs stayed accommodative. Now, production and employment contracted, while there were faster decreases were seen for inventories and backlog of orders. On the other hand, we did see new orders shrank less and price pressures ease. So that's also good news from inflation. So let's sort of wrap up what we see there in terms of some of those key takeaways in the US economy, Evan.
So it's the forward indicators that you've just provided that, again, go back to why you are seeing those big hitters in the investment bank world forecasting the possibility of 3 rate cuts in 2024, because the old adage is don't catch a falling knife. Well, the Fed does actually have to catch the falling knife. It needs to stop it.
Yeah.
And the tick up in unemployment, which is starting to move back towards what would be seen as a time to unwind, which is 4.5%. So we're not too far away from that. You then, as you perfectly alluded to there, Ben, is that overall, we're just starting to see increases in pessimism. We're just starting to see increases in areas that if you then forward play that in actuals, they tend to create contractions. So confidence is starting to move on the consumer and already in business anyway. You then look at the fact that there's an uncertainty about the future. Now, the seasonality I talk about at the same time is also there. Don't forget, August, September, October seasonally tends to be quite a soft period as well. So it all builds up to that period. And the big unknown that's also adding to the US this year is the election. So again, what that does is also difficult, just clouds the judgment again.
Well, usually people freeze in terms of their activity until they know an outcome. So that's also
and that's Jerome Powell, right? So that's exactly why he said, it could be this, it could be that. We just don't know. And he's got so many different factors that are impacting his outlook and what the board has to therefore evaluate that makes it just that much trickier. Again, do they go down the wait and see approach, which would argue they'll miss the falling knife because the crash will happen and they won't be able to release too quickly? Or do they go early and create a bit of a stoke and therefore, choke inflation up? And I want to leave on that point because that's what we're going to talk about with Europe. I think what's been fascinating, Europe is a little bit of it's not a canary because it's massive, but a bit of a gorilla in the coal mine, shall we say, Ben, with regards to moving rates.
All right, well, let's get on to that in a second. We'll just quickly summarise the China story because obviously second biggest economy in the world, we need to give it some attention. So we did see GDP numbers come out where the economy grew by a seasonally adjusted 0.7 in Q2, and that is after a marginally revised 1.5% increase in Q1. Now, looking at the chart, you can see that the Chinese economy isn't setting the world on fire, right? We're usually expecting big clip type quarters where we get sort of overall GDPs in the 6s and 7s, and we're definitely not seeing that at the moment. Now, the result is reflective of multiple headwinds, such as, what's happening at home in terms of extreme weather events, weak consumer and consumption, high local government debts, and ongoing property weakness. At the same time, we're also seeing tensions with the US. You're definitely seeing that in the political spectrum. Both of them want to have the anti-China sort of position when it comes to the election, and that sentiment is going to continue, and that's going to be bad for exports from China. Now, to combat this sluggish growth, the People's Bank of China has pledged to continue a supportive monetary policy stance. However, economists believe that the central bank was reluctant to trim lending, and we'll see this in a minute, further as rapid easing could mean cash flow or capital outflows from the country's struggling financial markets and put pressure on the yuan. And so this is an interesting story. That China is really in a bit of a rock and a hard place at the moment, isn't it, Evan?
Yeah, and this has always been the theoretical debate about China policies over the last sort of 4 decades and what would happen when it actually gets to a point of maturity and gets to a point where it can't just stoke itself. I mean, that's what it's been doing for decades. It stokes itself. It does have a 1.3 billion population and has always argued that it can look inward. I mean, that's what the political figures of China have always said. We don't have to worry about the world. We can look inward. And COVID taught them that they can't look as inward as they thought they did, because their economy is a manufacturing export economy. It is built on actually selling stuff to us and the rest of the world. That's still there, but we're also moderating our input from Chinese goods. And then the middle class and the rise of the middle class is fantastic to see, but it also means that their habits and their maturities come. And so the chart that Ben's got on screen around GDP, that should actually tell you that China is now no longer a developing economy. It's more a mature economy. And the policies of the previous decades don't work in a mature economy. And so they are in a rock and a hard place for a good reason. They have benefited for the last 40 years. Now they have to rethink how they go about their overall economic movement, because it's not going to be the same. What's so interesting is that the COVID was this hard line. It's been this, basically pre and post-COVID China economics will be what we discuss for decades to come.
Okay, so let's now have a look at the inflation story. And again, it's anemic, right? We saw the annual inflation rate edged down by 0.2 of 1% in June from a reading of 0.3 in the prior 2 months. And that's falling short of market sentiment and estimates where they were looking at a 0.4% increase. Now, that's the fifth straight month of consumer inflation, being as low as that figure since March. And it's showing the fragility in the economy and that recovery that's trying to get underway inside China. And that sort of then leads into what we were talking about in terms of their Chinese cash rate. So we mentioned that the People's Bank of China slashed key lending rates to new record lows at their July fixing meeting to once again try and help out the fragile economy and that economic recovery happening there. So the 1-year loan prime rate, the LPR, the benchmark for most corporate and household loans, was cut by 10 basis points to 3.35%. And the 5-year rate, which is a reference for property mortgages, was also trimmed by the same margin of 10 basis points to a reading of 3.85. So then we go into having a look at the unemployment story. So Chinese surveyed unemployment rate stood at 5% in June, unchanged from the previous month and matching market forecasts. On average, employees in enterprises worked 48.6 hours per week over that data period. And that should be a little bit of a timely reminder for our wonderful 38-hour working week that we have in Australia. All right, looking at the consumer confidence and sentiment data, it is still old data, and that's sometimes the problem with some of this lag data. But let's just recap in terms of consumer confidence in China decreased to a reading of 86.4 points in May from an 88.2 points in April. And also, although that's old data, the consumer isn't very optimistic at all at the moment in terms of what that story is, and that's supportive in that data. Retail sales decreased by 0.12% in June compared to the previous month, which drills home this whole idea of the challenging current conditions that we see in the Chinese economy. So finally, in terms of their business confidence, the official NBS manufacturing PMI in China stood at 49.5 in June data, holding steady for the second straight month and also aligning with market forecasts. The latest result marked the fourth time of contraction in factory activity so far this year. New orders, foreign sales and buying levels are all decline for the second straight month in a row. So, I think we've summarized China, that it's the story is certainly not so much an improving story. It's still a challenging story. So it'd be interesting to see what's going to come out in their data over, obviously, their summer periods as well, in terms of whether those consumers can get out and about. All right, let's move along now and start to talk about the Euro area GDP. And so I'm going to, Evan's got some great things to talk about here. So let's just go through the data first. The GDP for the Euro area expanded by 0.3 of 1% in the second quarter, which was the same result as Q1. Usually a 0.3% growth rate would be reported as a very sluggish indeed. But when you look at the charts, you can see that, based on obviously the last 12 months or the last 5 quarters, a 0.3 result actually looks looks okay, doesn't it, Evan?
Yeah, it does. And so you're just starting to see the remnants of taking your foot off the brake. So don't forget, the ECB was pretty much the biggest, central bank out there to finally fire the gun and cut rates in the
Yeah.
post-COVID world. And you're starting to see when you unlock a little bit of expansion in that space. But what's catching my attention is it is therefore, and as you should expect, when you take your foot off the brake, you start, allowing things to happen. So this is a breakdown of the main EU countries under the ECB's mandate and where they're going. And you can tell here it's all over the shop, right? So this is the catch the ECB's always got, is that in yellow, you can see the euro area, and in orange, that's the EU itself. So that's the one that I think we need to concentrate on. So that's that 0.3 that Ben alluded to. But look at the difference between the countries. You look at Germany, right? Germany's an interesting one. It was surprised when it did last week actually come out with data that contracted, and it was sluggish for what it is. But France offset that along with Spain. You look at something like Italy, right? So the big three, Germany, Italy, and France, they're not firing. They're certainly not excitable. And with that in mind, it shows that, again, there's still a lot of work to be done in the EU. But it does show that when you do take your foot off, even a small amount like they did, it does help. So disregard what's going on in Lithuania and Ireland. They're two smaller numbers. They're what we refer to as the periphery. But you can see that even with where they're at, it hasn't stoked the recovery that some people were expecting. But what it does allude to, and this is what Ben's also got on his charts about to come up, is the question around growth and price stability, because inflation's the interesting story out of the EU at the moment as well. And so this here, again, this is the movement in inflation in the Eurozone. You can see the steep decline we saw in the Euro rate, which is what you would expect. And if you have a look in around about sort of just after April, which is when they did move, there's a tick up, right? So everybody's made this argument, oh, hang on a minute, they've gone too fast, they've gone too soon. You can see that there's a tick up in core inflation, there's a tick up in the headline inflation rate. It's above their mandate, which is 2% at 2.6%. So how do you get inflation back to 2 but not cause recessions? And this is what the ECB is facing, because, again, the spread across the zone is really large. So you look at price movements in Ireland, you look at Lithuania, which I said to ignore. They're the ones that are also creating a little bit of a headache in this chart as well, because they are seeing pretty rapid movements. But the big three, prices are pretty flat. The other thing we also can probably put a caveat in, France is slightly ahead. How much of that is down to the Olympics? How much is that down to the demand that has been created by a global event? We'll see that in about 3 months' time when it pulls out. So that's why, although there's a lot of hawks saying the ECB can't go again, they can't go again, they can't go again, inflation's too high, it's ticking up again, overall, the market's ignoring that. And the markets has a 90% chance of another cut from the ECB in September.
So let's build on what Evan's talking about there. We saw the annual inflation rate in the euro area unexpectedly edge up to a reading of 2.6% in July from a 2.5% reading in June. Now that compared to a forecast where they were expecting it to be as low as 2.4%. So that is obviously a bit of a surprise.
Mm-hmm.
Now costs for energy went up 1.3%, way above the 0.2% that they saw in June. And the cost for non-energy industrial goods also increased faster. On the other hand, inflation slowed for services, which is the first fall in 3 months, and that's a good news story.
Mm-hmm.
And also you've got food and alcohol and tobacco. Now, excluding energy and inflation, which eased at a reading of 2.7 from 2.8. Now, core rate of inflation, that excludes obviously the price of food and energy, alcohol and tobacco over there, held steady at a reading of 2.9%. compared to an estimate of 2.8. So it's still a little bit stubbornly high. Now, among the, Evan was talking about the big economies there. The largest economies, inflation accelerated in Germany to a reading of 2.6 versus 2.5. France was up 2.6 versus 2.5, and Italy was 1.7 versus 0.9 from the previous month. And then you've got Spain, or actually eased to a reading of 2.9 down from 3.6. So a little bit of a mixed bag there. And that sort of takes us into what was the ECB's decision around the cash rate. So we did see they decided to keep the cash rate unchanged in July as expected. Now, the euro area monetary policy remains restrictive as domestic price pressures and services inflation are still high, with overall inflation expected to stay above target into the next year. So they've got a 2-year, 24-month window where they're trying to get that back. So the ECB aims to return inflation back to a 2% reading, and that will maintain restrictive policy and adjust rates as needed based on the evolving data, whilst not committing to a fixed path, which really means that they'll remain data-led with every month's decision. So this is where also, Evan, I want you to sort of unpack a little bit in terms of what's going on with rates over there and also what's happening in the UK.
Yeah, so rates over there are having that unknown sort of push-pull. So as you saw in the inflation figures that Ben read out, it's mixed. You look at the GDP figures that's being read out, they're mixed. So they have this conundrum. They also will be the first, what we refer to as G10. So that's obviously all the big main players in the G10 currencies to actually drop below Australia. And I'll come to that in a minute because obviously our cash rate never went as high as the rest of the world, but it's also likely to be the one that we will watch quite closely that will be the slowest to come down in terms of what we've seen. And we'll talk about that in a minute with what the RBA has done. But the EU has that problem. It has that problem of having to deal with so many different countries doing so many different things. So let's look at the UK, because the Bank of England cut rates last week for the first time in the post-COVID era. And not only that, they've sort of alluded to the fact that they may have missed the gun. They may have actually held at rates at a higher level for too long and are likely to cut rates again at their September meeting. Now, don't forget, they had double-digit inflation, so what the bank did was absolutely correct. But being too cautious about getting inflation back down to target, 2% in the UK, just like the European Union, has actually created a drag so much that they're now fighting off the possibility of having negative quarters of growth, of having unemployment get to a level that is unsustainable and you can't catch it. And this is what we talked about before with the US. The European zone, including the UK, is being that beacon, that gorilla in the coal mine, that the tightrope that central banks are walking is huge. Because if they get it wrong, and let's be honest, they will get it wrong, you are going to end up with a scenario like the UK where pain and suffering's been had, and now pain and suffering into the future is going to be had. The European Union's got a scenario where it's on the tightrope, but one wrong step, they could fall off and find themselves in the same scenario that the UK is in at the moment.
I think, again, I always like to picture it as this big water wheel, and the wheel is obviously the momentum in the economy, and the level of the water also determines how much water is being picked up on that water wheel.
Yep.
And so, to your point, even if they're trying to spin the wheel, if the water level's too low because conditions and spending and employment is lower, it's not picking up as much water. That's why it's always a very, very delicate balance in terms of how you thread the needle, in terms of how you stimulate and release money out into the economy, and obviously how you restrict that through obviously putting up the cash rate higher. Let's run through some of the numbers in regards to the European area. Starting with the unemployment rate, we saw the unemployment rate in the EA or EU area ticked up to a reading of 6.5% in June from an all-time low of 6.4% in the prior month, and above market forecasts remaining at that 6.4% level. The number of unemployed individuals rose by 41,000 from the prior month to a reading of 11.122 million. The youth unemployment rate reflects those who are under 25 seeking employment was 14.1% in June. That's slightly down from the 14.2% from the previous month. That's also a concern that those younger people can't get employed. Spain continues to have the highest level of unemployment among those major European area economies at 11.5%, followed by France at 7.4%, Italy at 7%. Conversely, the German economy has the lowest rate at 3.4%. And that's obviously based on a year ago that these jobless numbers were around 6.5%. So some, again, mixed stories inside that European area in terms of what the data showed us there. Let's move on to consumer confidence and sentiment. We saw the consumer confidence indicator in the euro area increase by 1 point from the previous level of -13 in July, and it's the highest level since February of 2022 and surpassed market forecast of a reading of -14.3 as per initial estimates. The European Central Bank's recent interest cut in June gradual, which is basically their goal of gradually seeing inflation decelerating, and fueled some optimism in some of those numbers. So markets were optimistic about future rate cuts in September and potentially in December, when thought the ECB had started. And they have also stated that they'll be data led. So that's an interesting position that we find ourselves in there. Furthermore, what we did see, the political concerns around the French elections recently have lessened, thanks to those parliamentary elections, in terms of the far right not being put into power and your sort of more moderates, or even sort of those lefties getting into power over there, has sort of alleviated that concern around that sort of legislative gridlock that we might potentially have seen in France as well. So that's a good news story from an economic point of view in the short term. In terms of the key takeaways, well, I think we've heard, Evan sort of talk about that. What we are talking about here is we really want to start to see them spending a little bit more, but not too quickly, where it reaccelerates inflation. But on the back end of that, I don't think the ECB can wait too long, in terms of getting that number down to that 2%. So they're still walking that tightrope in terms of what that looks like. Evan also mentioned we've got a big summer program over there, Olympics, and obviously lots of international travel over to Europe during this time as well. So it'll be interesting to see where we go. Any final thoughts before we move on to the Aussie market, Evan?
No, I don't. And the reason we need to now wait and see how they react, because I think what we're about to discuss is so important for all of us here. So let's dive into Australia, because it's been a fascinating sort of 4 weeks leading into the CPI, and then today with what we've seen from the RBA.
Yeah, so we're going to go deep on this now. And so obviously we haven't got a GDP Q2 number in Australia. We're a little bit slow in getting our GDP numbers out. But what we did see, let's turn our attentions really now to what the inflation story was. And we got quite a lot of quarterly data released to us on the 31st of July. So that now starts to inform that. And what did we see? Annual inflation first. So the Australian inflation rate rose to 3.8% year on year in Q2 from a 9-month quarterly low of 3.6%. Don't panic yet. Okay, that's the long-term trend. The short-term trend is actually okay. Alignment with that was in line with market consensus. Now, this was the first increase in annual CPI since Q2 of 2022, Q4 of 2022, amid higher inflation from both goods inflation, this is important, 3.2% versus 3.1% in Q1, and services inflation. So we saw 4.5%, which is up from Q1, which is 4.3%. We've been banging on about services inflation and how that's a problem. So keep that in the back of your mind. Mm-hmm. Now, the RBA's main means by which they make their informed decision is what they call the trim mean. So that's the core inflation. And the CPI increased by 3.9% year on year. And that's the softest rise in over 2 years, and slightly below the market forecast of 4%. So broad inflation up, core inflation at a softer level. And I think that has given us some comfort, but we'll know the outcome soon in terms of what's happening with the interest rate. So let's let Evan talk to and unpack a lot of the sort of subsets of the inflation story for the next few minutes. We'll go through a couple of those slides, and then we'll come back and find out what the RBA did today.
So Ben just alluded to the fact that core inflation, 3.9% year on year, 0.8% quarter on quarter. That's what the market really got caught up on, was that it was a slow ease in core inflation. The quarterly number was in line, not just with consensus, but it was in line with what the RBA had told us at their May statement of monetary policy. Yeah. Caveat, it was slightly higher on the year on year. So their overall May statement of monetary policy look for core inflation trim mean was also 3.8. So that brings me to this. We discussed this at the last update, which is around tradable and non-tradable inflation. And the reason I wanted to keep going on this, we still have a domestic problem. With all of the figures that Ben just read out and what I'm about to go through, we need to make it very clear, inflation is still too high. And it is coming from us. And this is the caveat that comes with what's happened today, what's going to happen into the future. The RBA has made it clear it is out of cycle with the rest of the world. We are now completely out of cycle with what's going on and what Ben and I have just discussed, because this chart shows you non-tradables. Domestic demand okay, it's come down from 5.1% to just shy 5. That shows very clearly that there is a lot of work to be done still to get inflation back to that grey band and that target that the RBA needs it to be. None of that, tradables has actually ticked up. So we've actually seen a move away that tradable inflation, inflation that can be affected by currency and international pricing brought in, that's also started to move slightly up again, which is something to be aware of. So that brings me to the next question about things like discretionary and non-discretionary, because we keep hearing about the cost of living crisis. This chart tells you that it's there. This chart shows you non-discretionary. They're the items that are referred to as essential that you can't not do without. Education, health, rent, energy across the board, insurance. So services. They are things that you cannot do without, and they are still banging on between 4.2 and as high as 5.8%, depending which one of those sectors you want to look at. And they are the areas that until they start to ease, you can't have real confidence that the RBA is going to cut rates anytime soon. Yes, we can discuss about what's happened, and we're probably at the peak of the rate hike cycle. It doesn't matter. There's still so much work to be done, and we're still a long way away from it, because discretionary inflation, it's good, 2%, that's where you want it to be. But you can also see from that chart, you have to go all the way back to 2010 to see discretionary inflation at 2%. So it too still has work to be done. It still has work to probably come back to trend of the last decade, which is more along the lines of about 1.5, 1.6.5%. So that's what gets me about this whole thing, because the final thing to really look at is we want to talk about us versus the rest of the world and where we sit in the cycle. And we're still so far ahead of the rest. And I need to point that out very clearly. Yes, we were later to peak, and the chart shows you that we were later to peak, but we're also, unlike the rest of the world, which you can see it's starting to moderate, but it's still falling in the rest of the advanced economies at 2.77%. We're holding and ticking back up at 3.81% for that headliner figure. And I go even deeper with the next one as well, is to compare core inflation and us versus all of these other major nations we need to look at. And that really gets me to sit up and go, okay, we've still got a lot to do. We've still got a long way to go before there's a confidence that we can say the RBA is going to start playing ball with what we want to do. I mean, you look, the UK has obviously got core inflation still above their mandate at 2%, but they've now got an economy problem, which is why they've cut rates. We've just spent a lot of time discussing what's going on with the US and also with the Euro area. Look at where they sit in terms of that inflation figure versus us. They're so far ahead of where we are. Now, don't get me wrong, the moderation happens quickly. We're talking months, but we are going to be last, unfortunately, in inverted commas, this race of the rate cutting world.
And we've got to acknowledge that when we say this is us, what we're also saying there is this is not just the consumer spending, but it's also the fiscal stimulus that we've been seeing to ease, those cost of living pressures, which a typical Labor Party must be seen to be doing in terms of helping those most vulnerable. But that is also, generating extra money in the economy. And we've seen huge numbers of employment in education, huge numbers of increased employment in health services areas. And that's all sort of adding to strong economy and stronger disposable income. And that's flowing into, again, what we've always talked about, which is, will a consumer spend the money or will they save the money? Well, history tells us they spend before they save, and some are forced spenders, but others are also, are they tightening the belt? So there's no doubt there's this middle ground of consumers in Australia who are strapped by their mortgage, and they are definitely cut back. But in terms of more broader, those more retirees with low debt or getting interest off their money, they're still spending. And then ultimately more people employed means there's more money flowing around the economy. Okay, with so much inflation data just covered, what did the RBA board decide to do after their 2 days of deliberations? Well, they kept the cash rate on hold. They've maintained a patient footing, keeping the cash rate at 4.35%. Evan, did they make the right decision in keeping the cash rate on hold today?
Possibly. I mean, again, they have been hesitant hawks this entire time. I mean, you've been hearing that if we didn't have the reason to do it probably at the end of last year, start of this year, we haven't had the reason to do it at all. And you listen to where the board sits. They want to be patient. They want to lock in the gains around employment, for example, which they constantly come back to as a mandate. As we just explained, though, in the inflation, there's a long way to go, and we'll wait to hear what Michelle Bullock says in her press conference around this, because she is clear that inflation is too high, that we're still treading the narrow path, and that's clearly still very much what's you can see in the statement. It's about treading that narrow path. The world's got uncertainty. You and I've just unpacked that with regards to what's going on around. So yes, it's the right call for now to some extent. We knew this was coming after last week's CPI. They'd put so much emphasis on that July 31 release, and any signs that it was in line or slightly better gave them the ability to do what they've just done, which is not raise rates. But the question, and the burning question, will remain: how long can they sustain this? Because it's now 3 years that inflation's been outside their target of 2 to 3%.
A great question, but I tell you what, there's millions of households out there who hold a mortgage who have had a sigh of relief in this decision for at least another 6 weeks. All right, so let's talk about the unemployment story here. And we saw seasonally adjusted unemployment increased to 4.1% in June, and that was up from the May figure of 4%, which was sort of in line with what markets were potentially forecasting. Now, the number of unemployed individuals increased by 9,700 as people looking for part-time jobs rose to 7,500 from a reading of 206,400. Meanwhile, unemployment climbed 50,200 to 14.41 million. Now, that's the most in 4 months, and that's easily surpassing market consensus of 2,000 gain and accelerating from upwardly 39,500 rise in May. Full-time employment jumped 43,300 to 9.94 million, and part-time employment gained 6,800 to 4.46 million. The participation rate inched higher at 66.9 in June from a reading of 66.8 in May, and the underemployment rate fell to 6.5% from 6.7% in May. Evan, what did you make of the numbers?
So unemployment is rising, that's clear, but more and more people are participating with the market. So there's an argument to be made that with participation ticking up as it is, migration, but also people coming back into the employment market. I mean, if you still listen to the surveys, people's expectation of finding a job is still pretty robust in where it sits. And I think that needs to be pointed out. So that comes to this, which is, hours worked versus total average hours. So it's a chart I showed a couple of months back that was ticking down. It started to tick back up, and look at those total hours worked. I mean, it is clear that we still have a pretty tight market. Helps that inflation story, unfortunately, to the upside. Sort of explains where the RBA sits at the moment with regards to why it's sort of walking this line that, it can't really do much in terms of any sort of relief, because relief at this point in the cycle is not what's needed. And then you look at how many jobs were created. That's just an incredible figure in terms of overall employment. As I said, they want to lock it in. I know they do. They've said that quite clearly, and that's great. Yeah. But, and it is a but, it does come with caveats. And that is clearly what's showing here, is that even though after having a period where we're sort of haven't really improved average hours worked for the last sort of 5 years, starting to move back, and total employment's pretty full. Participation's ticking back up. We've got a migration increase that's still relatively strong despite some government intervention. So you can't see demand changing because unemployment is going to get away from it. It is ticking up, I don't deny that, but it's not getting away from them.
No, it isn't. And I think, that's that sort of tightrope that they're trying to walk. I mean, one of the only positive bright spots of this is obviously it'll start to improve some of that productivity loss that we've been getting. So I think that's probably the only bright side in terms of we're starting to see, and people are probably a little bit more conscious of, their employment. We're seeing a lot more small businesses starting to liquidate or go into administration. We saw obviously Rex Airlines last week go into voluntary administration. So we're seeing a bit more of that in terms of some parts of the economy really struggling. All right, let's move now to consumer confidence and sentiment. So the Westpac Melbourne Institute Consumer Sentiment Index decreased to a reading of 82.7 in July, and that's the lowest in 6 months from 83.6 in that June reading. Now, as you can see here, I've highlighted a couple of these particular points. That is that the timing of when this data came out and when the surveys happened was on the back of a pretty ordinary monthly inflation print, and people thinking interest rates were going to go a little bit higher. I think that would have played in, to sort of those household finance expectations. Now, of course, we've got obviously the rate cuts, the tax cuts, I should say, that are coming through, which is maybe, in terms of what we see in the latest survey coming out in August later this month, might sort of give us a little bit of an idea. But then we saw time to buy a dwelling. That still sits very sluggishly at that particular level. But then, this is this odd thing we talk about in terms of price expectation index for house prices continue to grow. It's still sitting in an incredibly high reading of 161.2. So people still think prices for property are going to go up. But in terms of the time to buy a dwelling, I think that's really reflective of their hip pockets and what they can afford to at the current moment. Moving along now to the retail sales, we saw retail sales rose by 0.5% in June, and that was easily surpassing the market estimate of a 0.2% rise, albeit slowing from a 4-month high increase of 0.6% in the previous month. We saw sales for food, retail and clothing, footwear and personal accessories retailing, they're all increasing. Eased, my bad. In terms of sales, also slowed for, a no growth in cafes, restaurants, takeaway food, services remained unchanged. And obviously household goods retailing was also flat. Meanwhile, sales increased at a faster pace for other retailing, also was evident in the data. Now, around the grounds, this is where it does get interesting. We saw sales growth in New South Wales, Northern Territory and ACT, whilst moderating in Victoria, Western Australia and Queensland. So quite an interesting set of numbers when it comes to the retail sales, Evan. Do you want to talk to those?
Yeah, and this is what you should be seeing, which is in terms of actually, fairly moderating conscious decisions. It's also interesting from the point of view that you can see where the pressure points are in the states. So, Sydney continues, despite having probably the strongest cost of living problem, continues to surge ahead, whereas somewhere like Melbourne, which is still struggling to get out of its issues that it's had around COVID, it's still very much coming home to roost. So it's what you would expect. It's exactly as it should be. Again, the RBA's got that problem, right, where this is a good beacon indicator for consumer sentiment / consumer spending. Consumer spending makes up 50% of GDP in this country, and it's in a problem. So we've discussed all the way through this, that tightrope of when do you release the brake? Because if this starts to get negative quickly, you can't catch it. And therefore the possibility of a negative quarter or, God forbid, two negative quarters of growth can kick in because the RBA is trying to catch the inflation story rather than the whole story that's going on.
Yeah, we know we're in a GDP per capita technical recession, but obviously it'll be potentially fatal for the Labor Party if we go into a full-blown recession right across the economy. Now, this is an interesting one, right? In terms of the Australian business confidence, we saw the NAB Business Confidence Index surge by 4 points in June from an upwardly revised -2 in the previous month. Now, this was the highest level since January of 2023 due to an increase in 7 out of 8 industry, including manufacturing and wholesaling. So really positive there. However, meanwhile, business conditions edged down further. So from a reading of +6 in May, now down to a reading of +4 in June. And that's falling below the longer term average that we're seeing. And that's slowing the economy down. And we saw that starting to happen through late 2023 and now into the first half of this year. Now, in terms of those sub-metrics, we saw employment tumble, so a reading of 0 versus 5, whilst both sales, 10 versus 11, and profitability, 2 versus 3, were slightly lower. Forward orders were almost flat, -6 versus -7, amid a sharp fall in CapEx, so -1 versus 4, and a tick up in capacity utilisation, 83.5 versus 83.3. At the same time, labour costs growth fell by 1.8% in quarterly equivalent terms from the prior 2.3%. So hallelujah, wages are going down, which is potentially putting less pressure on inflation. And purchase cost growth also eased to 1.3% from 1.7%. Retail price growth was broadly stable at 1.5%. Now, that was best summarised by the head of the Australian economics, which was Gareth Spence, who said our take out of our take on from the survey is that it continues to signal another soft quarter in Q2, referring to what he is referring to there was a softer Q2 GDP print. So, we've got an anemic economy as it is in terms of Q1, but he's expecting, obviously, with that business conditions versus business confidence sort of playing out there. Any comments on the business conditions around Australia at the moment?
Yeah, I was surprised by the confidence number. I mean, considering leading into what we've just seen, that the possibility of a hike was there. The overall economic with regards to actually releasing credit and credit expansion was down, because last week also APRA came out and said very clearly it's not getting rid of the 3% buffer that it's got in lending. So that was all coming up. Business knew that was coming up. So I find it fascinating to see that jump. I think it's an anomaly. I think it's going to trend straight back to what we have been seeing pretty much throughout 2024, back end of last year, that business is just surviving, I think is the term. It's a horrible term, but I think it's what it's doing.
Well, I think you're right. I think it looks at potentially the stage 3 tax cuts coming in, and maybe that's where it is, but it might just be a blip if everyone decides to save it or not spend or whatever that looks like. So I think it's definitely an interesting story there, one that will play out over the next couple of updates. Now, obviously, each time we do these economic and RBA updates, we do also spend a lot of time in terms of talking about property. But I've got some exciting news for everyone here. What we're going to do going forward is Evan and I are going to talk all things the economy and the RBA. And then what we're going to do is Bryce and I are going to pick up and start to do regular updates on our Thursday show. So we're going to start doing sort of every 6 weeks. We're going to start doing really good market updates and also then focus in on a trend that we're seeing inside the property space. So I'm really looking forward to obviously working with Bryce and producing those particular results. And that starts with a very special mid-year sort of review that we're going to do that will come out on the 15th of August. So we'll be doing that and looking back at some of the predictions we made in our February forecast, and then also trying to forecast what we think is going to happen in the spring and summer periods. And then we'll start to, again, get into that regular hygiene sort of, once every 6 or so shows, we'll also produce an update. And then Evan and I will continue to wax lyric when it comes to the economic data from around the planet and also what's happening here back home. But I promised that obviously with that change, I still want to run through some of the results that we saw occur inside the Australian market with the latest CoreLogic Hedonic or Home Value Index. So let's take a quick look at that. We did see the national number. There was a rise of 0.5% in July. That's the 18th consecutive monthly increase in this value nationally. But it is a mixed bag in terms of when you start to think about what's happening in the quarterly trends. And remember, that's the sort of stuff we want to look at. The one-off monthly stuff isn't really where we want to go. We want to know whether the trend is your friend or we're also seeing some of that pace drop out of the market. And it is broadly starting to say that right now, I think there's a lot of that impetus is starting to fall away. And I think maybe that's also on the back of extended higher interest rates for longer. I mean, at the start of the year, we did think that we were potentially going to get a rate cut earlier in the year and then middle of the year, and maybe that may not necessarily be coming at all in 2024. So what we did see is Sydney's price growth slowed to 1.1% over the quarter, and that's a fraction of the 5% quarterly gains that it was recording this time last year. So that's starting to slow down our biggest property market. Then you've got Melbourne, Hobart and Darwin that are also tracking backwards, and obviously the ACT or Canberra is quite flat. But then you've got Perth tracking very strongly still at 6.2% and Adelaide reaccelerating at sort of at a 5% quarterly rollover there. And then Brisbane finally, their quarterly pace is also starting to lose a little bit of that momentum. So it was 3.8% over the quarter versus a 4.7% increase over that year. So it really is, sort of markets within markets, which is what we predicted at the start of the year. And we're starting to see that play out more and more as more local issues start to sort of impact in terms of people's desire to either relocate or move. And obviously affordability constraints also play into that particular story. So there you have it in terms of a bit of a brief update. Bryce and I will double click and go further into those types of updates. So that's it really in terms of wrapping up the economic and RBA update for August of 24. In terms of some of the big ticket items that we want you to think about, I'll go first and then I'll let Evan have the final word. But for me, it's certainly the big moves out of the US is really going to have a ripple effect around the rest of the economies of the world. And so I'm really interested to see what's going to happen in terms of those interest rate movements. Sticky inflation is still absolutely playing out here in Australia. So, that has got to be a concern. And, will the RBA continue to, lose patience keep their patience or potentially lose patience in the shorter term? That's something we've got to be thinking about going forward. And then obviously from a property point of view, it is a demand story. The demand is still strong in some pockets of the market. And we are definitely seeing some supply increase, and it's where those markets where the supply is increasing a lot, where we're seeing a sluggish growth or actually a decline in actual small declines inside property prices there as well. So, Evan, what's your final wrap takeaways?
My final wrap leading into September is: can we remain, inverted commas, the lucky country, considering what's going on with China, considering where we sit now in the interest rate world because of what our RBA is doing versus the rest? Can we get lucky? Can we actually have a scenario where we're importing, deflation, where we're actually also bringing in the interest rate movements that are happening around the world to us here as well? So that, I think, is what we've got to remember, is that the RBA's helped us on the way up, which hasn't gone as hard. It's not going to necessarily help us on the way down as fast, but we could get lucky because the rest of the world has done all the heavy lifting for us, and therefore we get away with it.
I think that's great final words. Now, I've got one final surprise for everyone before we go. Evan and I have decided that for the September RBA update, we're actually going to attempt to do a live update. So what we'll do is we'll have some more information coming out to you in the lead up to that particular event. So we might start, say, at sort of 2:00 or 2:15, and we'll talk about what's happening in terms of the data and the potential for making a case potentially for a hold or a rise or a fall in the different markets. And then at 2:30, when the RBA does announce their rates, we will be live and we'll be able to talk to the statement that we receive as part of that and sort of unpack that particular story. So definitely just changing up the format, trying to keep it interesting and fresh, but you'll be able to hear us potentially live on that Tuesday in September. So stay tuned for that. We'll be sending more information out as we get closer to that particular event. And so until next time, everyone, thanks for staying till the end. Always remember, knowledge is empowering, but only if you act on it. Bye for now.